gonna have to come in and walk through kind of the sales productions, a lot of the financial modules, the cost of startup costs, cost of goods sold, operating expenses. This was a little bit out of our expertise.
And you have 10 minutes now.
Okay.
Yes.
We can do it in 10 minutes.
I think we all agree.
You may not be able to read the slides as I whip through them, but we can do it in 10.
Quite a lot to go through in an hour, so.
Yeah, and we are going to rip through some of the slides so we can get to some that we want to spend some more time on. First of all, I'm Craig. I just want to know.
粤东，粤 Y-U-E Chinese names.
You don't?
Yeah.
You don't.
You can tell me 粤
Close enough?
because yeah.
Coming out? Okay, you don't.
Debbie.
Debbie?
Carla.
Carla. Carla? Carla.
Carla.
Carla. Got it. Okay. We're good. You don't? Debbie, Carla. Andy, I know.
Andy, yeah.
Yeah, Andy, I know. And the rest. So, all right, real good. Like I said, I'm just going to rip through these things. We'll always come back. There's 17 slides. All right, we can come back to these things, but I'm going to go through so we cover the material quick. Then we can go back. We can tell stories. We can do some other things.
Save questions for the end, or
Let's we can get one as we go, and I may say let's revisit that at the end.
okay.
I have 3 or 4 horror stories, if you will, about startups from the accounting perspective that I would like to share at some point in here. So I want to leave some time for that at the end too. And Jamie,
Will there be balloon animals?
let's discuss that at the end. Jamie. What?
We have to go.
All right, we might as well go into that.
We're gonna need a parking lot for Jamie, I guess.
Yeah, no, this is good. All right, and if you don't mind, I've been I'm a little more. Craig, my name again, and again, I do have a handout of this stuff too, and I'll just save that one because it's pretty small and I'll hand it out, but it does my email address on there so you can get a hold of me on that. I was a CPA right out of college, took the CPA exam, worked in public accounting for 6 years. I have to put the words inactive after the word CPA because that's the accounting rules, which really means that for the last 20 some years, I have paid my $25 a year to the Minnesota State Society so that I can keep my license inactive, but I don't have to take the CPA exam again, which back in my day was 19 and a half hours of exam. I never want to see that one again. All right?
It's worse than med school.
It was horrid. It was horrid. But that does mean, again, I spent 6 years in public as an auditor, not as a tax accountant. I will never give tax advice, and I'm very seldom give accounting advice, but I spent it as an auditor, and my stories will relate to being an auditor and kind of take that flavor in my accounting. I did spend 17 years with IBM Credit Union and Think Bank, and I went everything from internal auditor to running the mortgage department, to running electronic banking, to running deposits and all the lending functions, and then building data warehouses for them, and finally going out on my own as a reporting and analytics consultant 10 years ago. So that adds up, if you're doing the math, to about 33 years, which is more years than most of you have been alive. Just want to point that out in this group. I also do teach a few classes out of RCTC, primarily to the adult ed area, in terms of the analytics, my real work, business analysis. I am a business analyst for business intelligence projects. That's really what I do. I build data warehouses. I help people define requirements for that sort of thing. And I also teach a little bit of organizational development stuff in terms of personalities and styles and things. Real basic stuff. We're going to go through accounting in the next 10 minutes. Two real methods of accounting: cash basis, accrual basis. Cash basis is just that. You write checks, you record an expense. You get money from your customers, you record income. And it doesn't really, you might buy something, order something, and pay for it next month. The expense is next month. So there's never really a good matching of, a proper matching of expenses and income in a cash basis method. It is not according to generally accepted accounting principles, because that will require you to match that income and those expenses. And it really, at cash basis, net income equates to your change in cash. Did you spend more this month? Did you spend less this month? And that's really, if we're going to get into a little bit of that, but that really doesn't exactly tell you how your business is doing. It tells you how you're doing on cash. Accrual basis. We're recognizing revenue when it's earned, meaning if I make a sale and you pay me for it in 2 months, I recognize it this month. I'll get the cash in 2 months, but I get the income now. Same way, if I incur an expense this month, even if I don't pay it for it until next month, it's an expense this month. That also means we store up. As we're incurring liabilities, we know that we're going to owe something in 6 months. we need to record those expenses over the next 6 months. Even though no cash is changing hands, even though I haven't really maybe even seen a bill when it comes to that. In terms of proper accounting, we want to be fairly conservative when we're estimating liabilities, meaning that if it's measurable and if we know that we're going to have that expense, we're recording that. Because you don't want to be surprised with that liability at the end of this. So all of accrual says really just, doesn't really matter when cash changes hands. You just got to remember when you're making the money, when you're making your sales, and when you're incurring your expenses. That is GAAP. Generally accepted accounting principles require accrual basis accounting. There's also, as I'll mention in here, tax accounting. It's a little different. It's probably closer to accrual basis. There are some special tax rules, especially around property and depreciation and things. So don't worry about that at this point. If you run your business based on probably accrual basis accounting, if possible, and talk to a tax accountant at that point. There may be some planning that you can do, but in terms of small scale, I wouldn't let that really drive your decisions. Let's worry about cash. Cash and whether you're going to make money on that. All right. Financial statements. This is where we're going to blow through financial statements in 2 minutes. 3 basic financial statements here. We got the balance sheet, income statement, and cash flows. Balance sheet is as of a point in time. You'll always see it'll say balance sheet or statement of financial condition as of December 31st in the year, or as of March 31st. But it's always as of a point in time. You can see comparative balance sheets. So you might see them side by side. As of December 31st, 2019, and it'll have on there a column for December 31st, 2018 as well. So you can see the change between the 2 years. But it's always only going to show you those points in time. You might see a column that has change. That's helpful, but that's just math. That's just telling you what happened in between. The real difference about what happened. Okay, let's go stay on the balance sheet. Stay on the balance sheet, Craig. On the balance sheet, you think of the top part, assets. Okay, classic balance sheet. Assets have to exist, and they got to be properly valued. So if there's something sitting there on your balance sheet, you better be able to show it to me, or describe and give me the records on what it was. When I was an auditor, that's the first thing we do is say, does it exist? And that means accounts receivable. Does it exist? A lot of the ways that we would test if accounts receivable exists is after the fact, did you collect it? It's a good indication that it was there. You know, and we want it properly valued. So you can't put essentially vapor on your balance sheet. You know, say that I invent a value for something and stick it up there. It has to be fair market value. It has to be properly valued before you put it on your balance sheet.
What about really fuzzy things like a piece of software?
Piece of software, there's ways of making less fuzzy. For one thing, we'll talk about that a little bit in cost of sales. But when you're building software, you're recording those costs as you're building that, and you're putting that to that asset, because it becomes an asset. If what you're talking about isn't an item we're going to sell, it's going to be an item I'm building for my own use. You're recording your time, you're recording any contract time, any other software you have to buy to build this thing. You're putting all those costs into that asset. It's sort of like, think of it as building a house or building a shed. Whatever you buy, the lumber, the cost of the carpenter, whatever is going into the cost of that shed. So whether it's a shed or a piece of software, that's an asset. But you got to be able to justify those costs or those expenses expenditures when you incur them there and put that into that asset. So I got to be, when I'm auditing that shed or that software, you're going to give me the invoices or the time records or whatever it is that went in there, and I'm going to tick those off and say, yep, that justifies the cost that's on the balance sheet. You can't build it for $50,000 and put it on your balance sheet for $500,000.
But if it's your time, it's still pretty fuzzy, like how you gauge the value of your time.
Yep, and you know, there's sweat equity, so to speak.
Yeah.
You know, really not. Yeah, really, there's got to be some dollar value associated with that sort of thing.
Okay.
Now, if you're drawing a salary out of that company for that purpose, you can apply. I mean, then you're measuring that as a salary, you're putting in that's your job for that particular time.
Okay.
I think I'm okay on that. I think I'm okay. Yeah.
Do you mind just answer another quick question? How about your IP, for like copyrights or
Yep.
patent? You know,
When you're buying something, I mean, you're exchanging value. when you buy something, it's easy because you've got an invoice or something. You're exchanging value for that item. Yeah. Granted, you might pay $1 million for something. We still want to make sure that it's worth $1 million, and you just didn't spend $1 million for $10 worth of asset, whatever it is.
But for our group, say if our company or our startup, submitted patent, last year, it's granted early this month, so.
Oh, so you're granted that patent.
Yeah. Oh, we own the patent,
That's I'm gonna defer over there, but I'm saying
From a valuation perspective?
you didn't spend any money for it.
Well, I spent
Well, sure you
$5,000
do, yeah,
submission,
so I don't know how you do it from an accounting
Yeah.
perspective. When you look at it otherwise, you kind of use what did it cost to acquire the patent?
That would
So,
count. That would count.
You're gonna have external costs and internal costs. What are there any market comparables? If we had to go license the rights to practice under a comparable patent, what would that cost? Those are things we look at when we go to value it, like in an exit, like in an M&A or something like that. I would assume, I don't know if the same.
We're gonna any direct costs are gonna go into there.
Yeah.
But when it comes to
Those general intangibles that have a value that go past what it costs to do it because there's a market
Yeah.
value.
when you're valuing the company, you would probably do it that way. There's there's a movement towards market value accounting as well,
Right,
which would then
right.
allow that sort of thing. But in traditional GAAP, you would say, no, give me the invoices for the things you spent.
So I think it's
Put
going
it
to
on
come
there.
up in that sort of general intangible. It's going to have a value to you because it gave you a competitive advantage in the market, a monopoly, if you will. It may come up in a
So those
different place on the
intangibles are
balance sheet.
typically not included.
Intangibles can be on the balance sheet.
Okay.
You can buy a patent. You can buy a customer list. You can buy. There's even such a thing as goodwill, and we're not going to cover that in 10 minutes. Okay, and that's a sort of a market valuation thing when you buy a company, because you might buy it for more than is actually there, but you're buying that goodwill. You're buying that customer list. You're buying those other things. Those intangibles can go out there, and you depreciate your intangibles just like you depreciate an asset, like a shed, for instance. So there's an amortization that goes along with those sort of things. But those things can sit on your balance sheet, especially if you pay money for them. As an auditor, I'm going to make sure that you paid the money for them, that there is some support behind that value, that again, you're not bluffing me that this thing is worth $1 million, and really all you did was give your brother-in-law $1 million for a $10 item.
Maybe we're getting this, but when does this matter?
When does this matter? This is going to matter when you're going for funding. If you're going to go to the bank and get a loan, they're going to look at your balance sheet. They're going to look at your cash flows. They're going to look at your income statement. They're going to look at all these things, and you're going to have to. And they're going to look at these from a banker's eye. Is it reasonable? They may ask. In fact, a lot of my work as a CPA back in the day was because bankers would ask for an external audit. And when I go in there, I'm certifying that I'm giving an opinion, an audit opinion, that your financial statements are prepared in accordance with GAAP, generally accepted accounting principles. So I'm going to have to validate that everything exists, everything is properly valued, it's properly recorded, properly presented, and then the banker can get that, and they can trust my opinion as a CPA, and they can say, okay, if you say you've got $1 million in assets, there's $1 million in assets. And then they'll do their ratio analysis on their own assessment on there and say, are you in good enough shape that I want to lend you this? What are the trends, and am I going to lend you money based on that? So that's important on the balance sheet. It's also important for you to know where you're at. And here's horror story number one. I'm just going to work this one in. I worked for this company. I went in as a controller. And it was a home health care company. Had nurses going out doing in-home care, etc. Very busy, doing a lot of work. I came in, they had kind of a bookkeeper before. And it turns out really they had somebody that could kind of balance a checkbook. And I looked at the balance sheet. Lots of equity. Good. Assets, lots of assets. Accounts receivable are pretty high. I think we better collect those things. Okay? And but they had equity. And I went in there and I essentially did an audit after I'd been there a month or two, kind of got to know the business. Looked at those accounts receivable. We went through and we audited everything on the balance sheet. And I ended up taking them from something like $50,000 in equity to a minus $25,000 in equity. I mean, I basically said, you don't have a company here. Because they were throwing everything into accounts receivable and never collecting it. And I looked at them, and kind of thing where you would do a medical visit for $100, and Medicare only pays 50, they would put the $100 into accounts receivable, collect the 50, and leave the other 50 sit there. And their opinion was, well, we did the work, but you're never going to get paid for that.
More than lose, more than lose, right?
Right, right. So I went through there and said, nope, that 50's gone. Yep, we wrote that off. That's gone. That's gone. It's just sales discounts and allowances, really, because when you did Medicare work, you sacrificed that discount on it. They're not going to pay you that much, and that's where it just destroyed their accounts receivable. I found a political contribution on there, sitting on there from one of our local representatives, and what's this $300 to Jane Doe on your balance sheet? Well, we paid her, to do these things for us, so we're going to get that back in political favors. I'm going, write that one off. That's the kind of thing that it felt bad to take them, and especially since I'm working for this company and I'm watching the solvency of my employer go down the tubes as I'm writing these things off. But it really was I just butchered their balance sheet because they weren't doing proper accounting. So that lesson number one, recognize when you need an accountant. Had they looked at that balance sheet as they were getting to no equity, and consequently, also the same company, horrible cash management. Horrible cash management. And one more horror story. This was a really interesting year of my life. I worked there a year. And I eventually worked myself out of the job by helping them sell the company so that they could survive. But the owner, closely held business, 3 sister-in-laws, and family businesses. All my horror stories have something in common. They're all family businesses. Almost, or friends. But they like to give jobs to their family members and their friends. Jobs that really didn't need to be done. So we were paying people to do jobs that didn't need to be done, but we couldn't make payroll for the nurses. Problem. Again, we should have recognized that from the balance sheet, should have recognized that from the cash flows, from the income statement. They should have been paying attention to that, but they didn't have the accounting statements to prove that. Once we started proving it, it still didn't make sense.
Most of that stuff seems fairly common sense.
It does.
Yeah.
It does. Again, if you're having trouble making payroll, you might be having a problem someplace. That's there's a problem someplace. It may be, as Aaron was saying too, there's times when it's tight and you just live with that. You know that's going to happen. But you then know what the problem is and you're dealing with that and you're recognizing ahead of time. It's different to just say, we're short of cash, but things will get better. And I don't know why. I have another story about being short on cash. I'll bring that up in 2 pages or 3 pages here as we get into a different topic here, but never mind. Liabilities, again, we like to see conservative there. We like to see if there's going to be a liability, we reasonably expect it to, owe this. We want to put it on the balance sheet. So you want to basically be. I would look to conservatively value your assets as, okay, we can really justify this cost, and maybe, go high on the liabilities. There's a limit to that in GAAP too, but you really want to say, okay, if I got to go one way, I'd estimate high on my liability. Just because it fools me into that. It's sort of like putting money away and not seeing it. Income statement, go ahead.
Previous slide, changing capital from.
Yep, when you look at the bottom line, because you got assets, liabilities, and equity. And the formula is assets equals liabilities plus capital. They say assets equals liabilities plus capital. Capital is equity. And so when you're looking at that bottom piece of the balance sheet, that is either what people have invested in the company initially, or you have invested in the company, whatever it is, stock or just owner's equity in terms of a partnership or something like that. Or any change from year to year is your net income. So your equity is going to go up if you make money, and it's going to go down if you lose money, if everything else is equal, because your net income from your profit and loss is added to your equity on the balance sheet, one way or another. The other way it goes up or down is if somebody invests more money in your company. Equity goes up, cash goes up. Debit cash, credit equity. All right. Or I'm making withdrawal, I'm a sole proprietor, I'm taking money out. Equity goes down, cash goes down. Everything balances. All right. Good enough?
Yeah.
All right. Income statement is for a period of time. We're not in 10 minutes, are we? Yeah.
No, it's Jamie adding stuff to Slack.
It's comments about your presentation. No.
All right. Yes. Yeah. We'll fill out a form later. The income statement is for a period in time. It's for the year ended December 31st. It's for the month ended March 31st. Whatever it's for, but it covers that period of time, whereas the balance sheet is at that point in time. So this tells me what's going on with your company over that point, over your operations. I can see your sales. I can see your expenses for that time period. In this one, also profit and loss.
Sorry, can you repeat that distinction again?
Debbie.
Can you repeat that distinction again between the point in time and
Okay,
expense?
so again, a balance sheet looks at everything that exists on a particular date, on December 31st. How much cash do you have? How much is your shed worth? How much do you owe for your light bill? That's what it's looking at that point. The profit and loss is really going to say, how much did you spend on your light bill this month, to keep the lights on? How much did you spend on salaries this month or this year? And it's that period of time, because you can't say what are salaries at a point in time, as much as how did they build up to that point in time. Fair enough?
Yeah.
Okay. Again, we're following accrual basis accounting, so revenue is going to be for that time period, whether or not you got paid for it, and expenses are going to be for that time period, whether or not you paid for it. You might pay in advance, you might pay after the fact, but the expenses are going to occur during that time period, during those months. As an example, you're going to pay your insurance up front. You're going to write that insurance off over the time period of your policy, whatever it is, a year or 6 months or whatever it is. You pay your car insurance for your business, 6 months, you'll take that over the 6 months chunk until you have to pay it again. On the other hand, something like, I don't know, what you pay after the fact. Usually always pay up front. Revenue, you might get paid in a year for whatever work you're doing now and get paid out there, but you're recording that income every month as you're going along. Fair enough? So that we got proper matching of expenses and revenues on the income statement here. And again, at the bottom, in accrual basis accounting, the difference, your net income, is probably not going to be the change in cash. Because there's a lot of non-cash items on the income statement. Items like depreciation. So if I buy that shed now, that shed has a 30-year life. I'm going to take a little bit of expense over the course of 30 years. I laid out all the cash up front, but there's going to be a small expense on my income statement every month going forward for 30 years. And that's not a cash component of the profit and loss. So when I'm doing my income statement, you can't look at the bottom and say, I've made $1,000, show me that $1,000 in cash. You may have a net decrease in cash for that same time period, but you've got income that didn't result in cash or something to that effect. So you got to be real careful, and we'll talk about that a little bit on the cash flow statement here. But it's the nature of accrual basis accounting. It's hard to get over the difference between your personal budget, where you got the checkbook, and when money is coming in, things are good, and money is going out, that's maybe not so good. It's just something important to remember as we do this.
I mean, it kind of evens out like a big purchase that pays itself off over time.
Exactly. Yep.
Yeah.
Mm-hmm. And again, it's that matching. It's that matching of things, because if I buy that shed for my business, whatever, that is going to be useful to me over those 30 years, and I'm going to use that, and it's going to create benefit for the business. Hence, I'm paying for that benefit, with the depreciation expense. So I'm recognizing that cost, because I'm still, if I didn't have it 10 months from now, I'd have to pay rent. Something like that.
Maybe I'm too naive. I did not handle well my own personal finance. So why are we even doing this kind of a accrual approach? This kind of special accounting business.
Mm-hmm.
So just tell me why we do this?
Okay.
Upfront.
The biggest concept is that matching thing. So and think of it. in terms of if I'm the banker that's gonna lend you money, you had $10,000 in sales this month, but you didn't get paid for it. But you had $9,000 in expenses that you wrote the check for. You know, and you know, so if it was cash basis accounting, you would say, well, you lost $1,000. Would you want the banker to look at you and say you lost $1,000, or would you like the banker to look at you and say your net for the month was $9,000 profit?
I see. Okay,
That's the way they're going to look at that and think of it for the year versus a month, that sort of thing. But that's the way you're going to want to say, what are your ongoing sales versus your ongoing costs? Again, as Andy mentioned, over the course of time, it kind of evens out. You know, you don't get those big fluctuations from month to month. But when I look at any given month, I want to be able to say, when I look at the sales number, I should be able to, again, support that with invoices that say, here are the invoices for that, whether they were paid or not. And when I look at the cost of sales, I'm either going to look at invoices to support those units that you sold, or the time records and things where you built those units.
So it's a clearer view of the actual big picture versus where you happen to be at a point in time.
Right.
Which is valuable in a bunch of contexts.
Yeah, that helps a lot, because
Okay.
I always get confused. Why we do this kind of?
So
Yep.
if you take a contract in April that is a 3-month contract, you're not gonna get paid, do you then take on the number of the total job for the 3 months that you're gonna work, split it into 3, and give yourself one every month, or do you give it to all yourself in April?
No, all things being equal, let's say there's an equal progression of work, you would take 3 equal installments. And what you would do is, think of the accounting entry. We've got debits and credits here. I have to go there. Sorry, I'm going to go to debits and credits. But you're going to get paid in 3 months, right? So what you're going to do is say, okay, I'm getting paid in 3 months, and I'm getting paid $90,000 because I can do that math in 3 months, okay? And equal progression of work. I'm going to record the $30,000 of sales my first month, and that's a credit to sales. The debit is going to be to accounts receivable, you know, that, or to, and essentially, because now I've incurred that, I've recognized that revenue, and I'm going to get this money. I actually might record the $90,000 as accounts receivable, but the initial entry would be $90,000 in deferred revenue. So you got an asset and a liability. Now when I record that first $30,000, I'm going to record $30,000 credit to cash, $30,000 debit to deferred revenue. Now my deferred revenue is $60,000 less. The next month I take another 30, that goes down, and the last month now I've got my full 90. So I would take it over the 3. There's also the percentage of completion method that we kind of get into, that sort of thing, that says over that for that 3-month period, if you really didn't do any of that work that first month, but you caught up in the second and third, you might not get to recognize any of that $90,000 that first month, but you catch it up in the second and third month. This is getting way deeper than I thought, but this is good. This is all very, very good. And give me a time check. Sorry, without even looking.
We're at about 7:25, 7:20.
Oh gosh. And you wanted to get going at 7. Okay. Well, we're going to get there. We're going to get there. We are. Cash flows. Basically, it takes your income statement, your net income, and it adds back all those non-cash items. So it adds back depreciation. It adds back any amortization of various things. It adds back any debt service. Debt service, again, isn't an expense. When you're paying back that loan, for the most part, you're paying principal back. That comes off the balance sheet, doesn't go on the income statement. Your interest expense goes on the income statement, but the rest of it does not. Okay, so that's got to be back on the cash flows because it's not in your net income. So we add those things back, non-cash things. And again, capital expenditures. Again, if I spend money on that shed, that's a cash outflow. That's not on my income statement because I spent money and put that asset on my balance sheet. Got that one? Close enough?
Close.
By the way, you've got my email, and I will happily get into any of this stuff. as
Play
we
it
go.
back over as many times as they
All right,
want.
sounds good.
We're doing cash flow next week, so
Okay.
we'll look
Okay.
about that more.
Yeah, and we're gonna. And now the real reason I came here to talk tonight was projections and how to do projections. You have some spreadsheets that you can download from, the Kaufman site. And they had, I think there was a KC Running, and there was a toy store, and there were some other things. And they take you through three different sales approaches. They take you through and we'll get to those too. But I'm not going to go through those simply because we're not going to have time to do that. I would happily sit down with any of you in the coming week or two or whatever you want to walk through those examples if you want to do that. I'm going to give you an example of a shortcut approach tonight that I've used for a couple different companies. And it's in the handout too, so there'll be a very small text version of this thing. We're going to talk quick about projecting startup costs, just because Amanda, you mentioned that too, and I think Aaron talked about that. So if we cover old ground, we aren't going to cover too much old ground. We'll talk about projecting the sales and the cost of sales. First of all, startup costs, as you might expect, they're incurred prior to starting operations. So these are things as you're ramping up. And one thing is, they kind of have to be things that you normally would put on your income statement to begin with. So they're not, if you can't deduct them in a normal business setting, you don't put them in as startup costs. Okay.
So you wouldn't typically put sweat equity, for example,
No.
in here at all?
Not unless you're, not unless it's,
Unless you're taking money
you're
for
taking
it.
money out,
So I don't understand. What do you mean?
If you're doing work to not get paid. So like if I'm working on something I don't collect a salary, it doesn't count.
This is really directly affecting your burn rate, so if you're not getting paid for something, it doesn't go on.
Which is really common in a startup.
So this again is, these are going to go on, these are some of those things that are going to go on your balance sheet and not be expensed right away. So again, as an auditor, I'm going to make sure you got an invoice for it. And they're an upfront outflow of cash, but we're going to amortize those. Amortize and depreciation, kind of the same thing. Means we're going to recognize it over the course of over the future. For several, it could be, and it's always over the life. How long are they going to last? If I buy the shed, it'll last 30 years. If I buy a computer, maybe 3-4 years. There's tax laws on, that's where the tax laws come in, because they let you take those things faster. We're not going to get into that. If I buy a car, there's tax laws on how you can depreciate a car in real life, how long it's going to last, 5 years, whatever else. So you estimate that useful life of the asset, and you write it off. You write it off over the course of that life as we go. Same thing we're going to do with these startup costs. And the startup costs, some common things, any legal costs associated with incorporating or any setting up your business in that fashion. Any accounting advice, you might go meet with an accountant. You might buy a new accounting system, whatever else, things that you can start doing. Those things that session with the accountant. Any training that you particularly need, any website development, some of these things that are initial, gotta have them to do the business. They're gonna last me for a while, but they're not doing anything for me right now. And there is some, you're paying out some salaries during that time period too, as people are ramping up. Maybe not to, if you're like me starting up a business, I just went in there, on my business, it's just me. I'm gonna go out and do consulting. I don't need a building. I need a computer probably, so I'll show you my startup costs if I get time here, but it was really a little bit of computer expenses, a little bit of legal work. I didn't get any accounting advice, probably should have. Some real accounting advice. Like I say, I always introduce myself as a recovering accountant because I'm no longer actively practicing, but I do fall off the wagon often, and I'm always falling back into finance. No matter what I do, I get drugged back into finance, usually kicking and screaming. I had lived a perfectly happy life out at Think for about 15, 12 years, and then the CFO resigned, and I had to be interim CFO for 3 years. And it was like, no, I love my data, I want my data, but they drugged me back into finance. I did get back into the data world too.
Tell me again, what is the overlap with financing versus accounting?
Okay, accounting and finance. I would say finance is at a higher level. It's a bigger picture. So if you're a CFO, you've got a bigger picture than you do as an accountant. A CFO might be an accountant too, but not all accountants can be CFOs.
Okay.
That's a, executive viewpoint of accounting, and you're really doing. If I'm an accountant, I'm probably making entries. I'm probably recording things. I'm probably generating financial statements. CEOs are getting that stuff. Or CFOs, excuse me. They're getting that stuff. They're interpreting it. They're strategizing to say how we're going to make this different next year. They're working with the CFO on funding, or the CEO on funding opportunities, on investments, and that sort of thing.
So based on that, Aaron is a CFO. So do you hear that in what Aaron, the perception he was, in the view lens he was talking about? He's a CFO.
Yeah.
Okay.
Got it. Yeah.
Okay, and people are working, bookkeepers work too, I'm not gonna decry that, but there is a difference between bookkeeper, accountant, and CFO. And it's kind of that big a difference.
Yeah.
All right?
Thank you.
Good. Capital expenditures, again, we talked about that, the shed, the car, the other things.
Yeah.
Good. Sales, you're talking a couple different approaches on this thing. And the comparative approach says really that there's other people doing what you're doing. And this is all in your material, and they got the examples and they've got the spreadsheets to help you work through this. The short version is you're doing research, whether it's online or talking to friends that are doing the same thing. If you're a coffee shop, you're looking at other coffee shops. You're looking at if there's a publicly traded company that you can see and you can see their statements and their financials out there, great. Then you can compare what your scale compared to them. You can get an idea of that. You can watch. An average sales approach really gets away from big numbers and annual type of numbers and saying, how many widgets am I going to do in an average month? You might, if you're a coffee shop owner, I'm just thinking of making this up now, but you might go sit out in front of Starbucks and count how many people walk in on a given day. Or you might, if you're a retaurant, how many customers are going in and out during the lunch hour. You're multiplying that out by how many meals. You can build your seasonality into that sort of thing. If you're retail around Christmas time and that sort of thing, you're going to build, increase your sales as you get closer to peak times, but you're kind of average, working around that. On average, I'm going to sell this many widgets. Fair? Bottom up really says, now I'm going to get more granular and say, I can be specific and I know exactly what I'm going to sell at a given point. And it usually might be bigger items, bigger ticket items, other things. I can give you an example of this. I worked with somebody who was starting up a women's ministry. And she wanted to put on these conferences for women to come to with speakers and presentations and things and music and all kinds of things. And there, she says, I'm going to do 2 big conferences every year and 2 small conferences every year. Okay. That was pretty easy, because then we started talking about, you got one in January, you got one in June, you got one in April, you got one in September. And talk about seasonality, and you got one event, essentially, each of those times. So now we're talking how many people are coming, how much you're going to charge. So we build this, from the bottom up, we built this. What's your total revenue going to be for this? What are your costs going to be for these events? And then we looked again, and we said, on average, how many books am I going to sell in my online store? So we had a small income coming in every month for online sales, taking the average approach as opposed to, I know I'll send 10 books that month. And comparative, she was unfortunately comparing to some pretty well-known speakers. She was projecting some 1,500 attendees at these big conferences and 50 at the little ones. And I think she got 50 at the big ones and 5 at the little ones. So there was a little bit of estimation problem in here, but that, at least she went through the planning up front, and reality just didn't quite match. But again, that's one of the purposes of planning, so that you can kind of get used to. If it didn't work the first time, we either change it the next time, or we have to do something different on that. 3 different approaches on the sales approach, with one little horror story on that. Okay. This is that simplified version I was telling you about. And it's all in one place. It just has, this is a year 2 projected income, so it has every column for every month. What are my sources of revenue on this thing? My cost of sales, and then has all my operating expenses down here. So you can see that I'm going from my gross profit, then deducting my all my operating expenses to get down to the total expenses and my net income. And that just lets me, and you can see that these things are really general as I'm going across. There you go. There you go. Hey, I love matching. That's I love what we do. So I'm just estimating on these things, and I might not spend $50 on accounting one month, or $100, whatever it is. Might fluctuate a little bit on there, but then the next year I do different projections if I know what I'm always comparing my projected to actual, or my budget to actual also, so that I can say, do I need to estimate differently next year? That sort of thing. But it's at least a great way to say, get them all on one page where I can look at this and say what's going to happen over time. And then, and just as I hand this to you too, you can get as fancy as you want with Excel. but as an accountant, I kind of get into Excel. And when I build these things, I like to build formulas and tie them to variables. So all of this cost of sales, this salary down here, this cost of sales is really salary, but it's the billable hours portion of salary. That's the hours I actually would spend working. This is my year 2 of my financial plan when I started 10 years ago. Year 2, my year 1 was really my year 2. My year 2, I'm still waiting on, but I was about a year behind on my planning, or a year off on my planning, when things actually materialized.
So I noticed, and this is going back to more sales rather than projected income, but in there, in the Run KC example, they estimated sales growth, and it looked like they were estimating from year 1 to 2 of revenue like 25% growth. That seems extremely high. I thought it was more like 5, and then, or maybe 15 from 1 to 2, and then like 5.
I guess it depends, and Aaron sort of referred to that too, as to, if you're really going to have exponential growth or whatever, you got to allow for that in there. Because I might not have any sales until I know that in October I'm going to release my new product. Boom! I expect that to go up, or I'm just working. Now we get the patent out, or now we're going to do a press release. Boom!
Yeah.
Whatever else. So that's kind of that bottom-up approach too, where certain events are going to occur. You're going to budget around those things. Seasonality, retail sales. But I don't. When I'm starting one with a brand new invention, whatever else. Yeah, go with whatever the.
Yeah,
It
I'd
totally
say,
depends on the business.
Oh,
right?
it
Like if
does.
it's a growth software startup, you should be doubling that every year, maybe, or something, for example.
Yep. There's you could have 0 all the way across, and then all of a sudden, jump to $10,000. It really is gonna. But I think that's the best part of doing a model like this. All models are wrong. Some are useful. Okay. I love it. But you can look at it and say, is that even reasonable? A banker's going to look at it and say, are they reasonable? I can't see that you're going to get. And this person I was working with with the ministries too, I said, is it reasonable you're going to get 1,500 people at a conference? Oh yeah, it happens all the time. Okay, when you're an internationally known speaker, you get 1,500 people coming to see you, that sort of thing. At the same point, family and friends. I mean, go back there, horror story component of that. I looked at the costs of those conferences, because this person would have a band to come in, for the weekend. And these were going to be, go away for a weekend, do the conference, come home. And the cost, there was no cost for the band. And I said, well, where are you going to pay the band? Well, I don't pay the band. They're all friends of mine, and when we've done these little conferences before, they all donate their time. This is your business plan. Your friends are going to come in every, once a quarter, go away for a whole weekend and not get paid. You got good friends, But that's actually the way things started, and pretty soon the friends didn't want to show up to play in the band anymore after it got old. Got to be realistic about the things too. But family and friends, it's tough. It's tough. I just hate to see, when I saw things happen as I was an auditor to family-owned businesses and family-run businesses, I said, I'm never going to do business with a family member or a good friend, because it's going to go bad. That's my opinion. Cynical, but
Rick, a couple of things. Assuming this column is all the annual.
Yeah, that'd be annual. Yep.
So because help you see the big picture.
Yep.
The other thing, why you put this thing on here, not on the.
Okay. So that's going to get cost of goods sold, and let's go there next. Can we do that?
Yeah.
That's exactly where we're going, because if you added up this amount, the 36 and the 15.4, 30,600, 15.4, if you add that up, it's going to should equal. Where did I go wrong? Is that right? Oh, I changed the number and I didn't change the formula. Okay, that should have added up down to, I was playing with it. And I took a snapshot. This should add up.
So which one should I?
This is my billable hours where I was actually working. This is things where I'm doing consulting, I'm doing speaking, I'm doing teaching, whatever else. This salary down here would be my place where I'm out knocking on doors, I'm having lunch with somebody, I'm making contacts, I'm writing content, I'm doing something that is not related to doing my work. And that would be the equivalent of an accountant in your company. They're not doing work that relates to your sales. They're doing work that relates to something else. We're going to get into that in cost of sales here in just a second. All right, but that's why that was in my line of work as consulting. That's sort of my cost of sales is what's my time worth up there, and I'm taking a salary for that, so that's where it's going. The rest of my salary is I might be doing accounting work, although I'm a horrible accountant for my own business. Don't tell me. We're not going to talk about that. Right.
And also the red means negative, right?
I put it in there as red to call attention to say that is a subtraction. Yes.
It's a subtraction.
Yeah. So you can see 8,500 minus the 2,600 would be the 58, gross revenue, so to speak. And theoretically, if I did it right, 26, 29, and it should be 5,000 here. These two numbers, 2371. That would be a total salary of 5,000, but 2,300 down here, and then kind of the general salaries, 2,600 up here, and really when I was doing the work. And this is projection, but then I can fiddle around with my billable hours and things and see what happens too. Ideally.
So this number plus this number is 5,000.
There's that number right there. It pulls it. This is just a formula, so this is pulling from down here.
Yeah. But where are those numbers?
23,700 right there. 2371 right there.
Yeah, I know this.
There. Okay, and they add up to $5,000.
Yeah, that's got it. How about this part?
Oh, that's not part of salary. That's all these different expenses.
You are not. Where does sum up somewhere?
Right here. This sums to here.
But why you only for this 39 to 51 only took the 2371 here?
Because that's just this component here. So total expenses is this.
Yeah.
5,800 is my gross profit. Sales minus my cost of sales equals my gross profit. Gross profit minus my expenses equals my net income. Gross margin, gross profit minus my operating expenses equals the 1920.
Okay.
It's easier if you can see the spreadsheet and see the math. Yeah.
Okay.
All right.
Do you mind sharing this with us?
No problem. In fact, like I say, I've got your handouts that has it on there, but I can give you this, show you the spreadsheet too. Yeah, that's not a problem.
Thank you.
Good question, but and it's easier to see it if it's math. But this is the way your income statement is going to be laid out.
Yeah.
So when you read an income statement, it's not necessarily going to be plus minus plus minus plus minus.
Yeah, I always
kind of
get
thing.
confused which one minus which is because this is.
Yeah. Generally, you're going to have positives for expenses. You say, wait a minute, they're negatives. Well, you got to do the math. So you know how to read it. If I had a negative expense for some reason, if my accountant gave me a whole bunch of money back this month, it might be a minus 50. They gave me a refund, but it would show up here as a minus 50 because it was money coming back as opposed to going up. It's backwards. Accountants like to do that. Let's talk about cost of goods sold, shall we?
Yeah.
And I thought, rather than drag this through a slide, I'll just call attention to the slide in one thing, because in your materials it says all the costs associated with making and selling your product. Really, it's not and selling. It's with making your product. Sales salaries really don't go into the cost of goods sold. Because what if you really got a bad salesman? It isn't logical. I'll show you what goes into the cost of goods sold, and I think we'll use that with an example.
Ha! I win.
You win. Jamie wins. I learned to make balloon animals when my kids were younger, and we often work them into classes. Okay, so let's do a balloon animal example of cost of sales. All right. That is a leak. Okay.
So that one gets added extra.
Yes. All right. Let's try this one. Manufacturing process. Okay. Who's got a product they're manufacturing? For your business. Software. Are we building software?
Software.
There is a software, but it,
Okay. Okay. Well, we're going to build something. All right. So Watch very closely. I'll ask you to reproduce this later. Trade secret.
Don't show us how you're doing it then.
He does it so fast.
And we have your classic balloon dog. And kids always say, I want eyes. Yeah, okay, so we put eyes on him. And a little smirk. Alright. So we have my product, the balloon dog. It's my business.
Virgin
There we
Tree will
go.
stand up.
We have a balloon dog. Here, I'll model it. All right, let's talk about cost of sales. Cost of goods sold. When I sell this dog, what goes into the cost of my dog?
Material,
Material being
the
Balloon.
balloon,
the balloon. Okay, good, good.
the manufacturing process, the pump.
Well, yeah, I bought the pump a couple years ago, but I need to take a piece of this and attach it to every balloon that I make and sell. So this is essentially, there's a component of cost of goods sold called applied overhead, where it's things that aren't directly, part of it, but they're used. Your shed could be, that sort of thing. So we've got part of the pump, and might be a real small piece, but yes, part of the pump. Go ahead. What else?
Your time?
My time. I just spent time blowing it up and twisting the thing. So my time goes into this because it's direct labor in making this thing. Yes, what else?
And your skill. Well, I mean, because
That's in my time.
Well, I'm not sure your skill. Split your skills because you can hire somebody else do your thing. You teach somebody else. You can skill it up. I don't know.
Okay. I would call training of the new person a general expense because that training isn't directly going into the cost of this thing. But once they start laying hands on the balloon, yes. And I might have to pay them, I might be able to pay them less
Yeah.
because they're not obviously as skilled at making balloons as I am. But, so I would pay them less, so it might take half a cent off this thing or something like that. Yeah, you're right. You're right. Okay, what else?
Sharpie's like the pump.
Aha, Sharpie is like the pump. Because I have a huge amount of ink on this thing. But that's what you need to account for. Yes, we have Sharpies on the pump. What else?
Were you gonna sell it, or?
It's sold. Yeah, consider it was sold. So.
Do you count defective material?
Ah, we have waste and spoilage. So even if I have to throw something away, it gets figured into the cost of my sales.
So
yes.
Jamie access the market. Because Jamie here, you access the market here, so we can see 5 people here instead of 1 people. I don't know.
Oh, the access to the market. Okay.
Yeah.
Actually, that would be not a cost of sales. That would be a general expense. So that would be things like even promotion.
Yeah.
Promotional expenses and stuff is down below the line, down in that long list of expenses down there. My general expenses. Yeah.
Customer list is
Customer list would
access to market.
is access to market. Yeah, but doesn't relate directly to this because I may not have sold to anybody on that list for one thing. Okay, what else? There's maybe a trick one in here.
Air.
There's
How about your time?
Well,
my time, yeah, my time going in here, definitely, because I twisted and everything. I didn't tell you about one thing. I have to store my balloons in the refrigerator or they go bad, and they pop. Actually, I carried these around in my backpack for a long time, but theoretically I store my inventory in the refrigerator. So the cost of the refrigeration, the cost of the storage. So if you got inventory that's sitting around in a shed, or you're having to pay to store, or you're refrigerated like frozen food distributor, you're going to pay for that storage expense. So that needs to go into this sort of thing. What things are not? We've talked about some of them. If I had a business card that said Craig's Balloon Animals, nope, not part of this. If I had, let's see, a website, not part of this. Doesn't relate. So anything that you can see that touched it, that was related to the building of it, or is the component itself.
Like a stall at the farmer's market to sell these would not count?
No, I wouldn't count that. I wouldn't count that because, that's going to be. Could you sell it without that?
Maybe.
Possibly.
Maybe not.
Yep. You might be able to say that's the place I build it. That's the place. But I would say, I would almost want to keep that. You're going to have that. For one thing, here's another way to think about it. You're going to have that stall whether you sell anything that day or not. You're going to be there every Saturday, no matter what. And another way to think about cost of goods sold is, if you had a period of time where you had no sales, what are the expenses that still keep happening? You're not making anything, you're not selling anything, but the expenses are still happening. Those are all down in that almost all down in that operating expenses. You're still paying your accountant. You're still paying to keep the lights on. You're still paying for your web hosting and your internet and your phone and everything else, but you're not making and you're not selling. So all those things that are happening still probably are not cost of sales.
So if you have applied overhead, meaning something that you can subtract a dollar value to, like every time that you make something. So if you have a pump, assuming that pump will only last 10 years, you subtract a little piece of the pump every time.
Yeah.
From the
Yeah, and there's accounting tricks that I'm not really going to get into, but you really would come up with a factor per unit that would go into that of applied overhead. So if you think of those two divisions where I had cost of sales up here and I had the operating expenses down here.
Because overhead is rent and lights. And
Overhead, yeah. When you have a manufacturing facility, a part of that is going to go into the cost of your equipment or your cost of your sales. Yep, yep. So I'm going to say. And all that stuff is, wait a minute. Again, I bought the shed 2 years ago. You get that depreciation that's happening. What's really going to happen in the accounting tricks is you're going to do some math behind the scenes, and you're going to calculate per unit how much of the pump, how much of the shed, how much of the refrigerator is going to go into that per unit. Essentially, I'm going to move that from down here to up here. So you might have something down here that's a negative expense that says applied overhead, and that goes up here.
We'll probably have to wrap up, unfortunately, with final thoughts, so we give some time to Ann.
Yep. Okay.
But Craig is available.
Yeah, I am.
He has great handouts.
I'm going to share one horror story on the cost of sales. Then I'm going to get out of your way. Okay. Yeah. I was called in after about 3 years of public accounting, and the partner said, "Craig, I need you to go visit this business, not as an auditor, but to help them out." And we went down there. It was a family-owned business manufacturing things out of steel. And there was a few brothers and a mom and a dad. And the dad was the salesman, and the brothers were building these things, and the mom was the bookkeeper, and they were working like crazy. They were super people, just honest, hardworking people, working like crazy, selling like crazy, and making no money. And when I went in there, they had really no accounting system to speak of. She wrote checks and recorded money as it came in. When they bought steel, they said, "Oh, it takes 50 pounds of steel to make this thing. We bought it for this, we'll sell it for this." The dad was out there selling like crazy, selling below cost. Because they didn't count all of the money that it was taking to build, the time it was taking to build them, the expenses that they were incurring to build them, the costs of the supplies they were using to build the gas they were using to weld, any of that stuff. They weren't factoring any of that stuff into their cost of sales. So they just simply were pricing things too low. They had no idea even how to price things. And they were just throwing money out the door. But working really hard to do it. It was just delightful people. I will be available. I'm going to wrap up on that note, on that downer note there, I guess. Accounting isn't all that hard. You pay somebody else to do it.
Yeah, that's what I was just going to ask.
Yeah.
So big picture, as an early stage startup, I'm not going to internalize most of this. I'm probably going to pay somebody to do most of it and do common sense is a tricky term, but
Yep.
common sense for the most part.
Yep, and I would do that. I have a very good friend who's a CPA that does this sort of thing. He's very busy right now because he's the tax accountant primarily, but he does write-up work. And if he doesn't have time, he would go to somebody that prefer somebody that does. But yeah, you would pay somebody to do it. And by the way, if you give me your checkbook for the year, your check stubs or whatever, and the supporting paperwork, I can recreate an accrual basis accounting statement for you from your checkbook. You just do it. would take some interviews, it would take some look at your records and stuff, but essentially you can adjust from a cash basis to an accrual basis pretty quickly. So you don't have to know this stuff as much as recognize that somebody else is doing it for you.
If I'm not gonna get around to funding in the near future, do you still need this for your own?
I would do it for projections. I did these things for myself, the projections at least, and I wasn't going to go out and get funding because all I had to do was start doing some work.
You could do more rough projections too, couldn't you?
Yes.
Okay.
Yes. Yes. I mean, you could sit down and scribble these things out on, again, a napkin kind of thing if you really wanted to. But I think the important piece is going through the mindset of what are my volumes going to be, and what's it going to look like on paper. But you're going to want to know that eventually for your own purposes. If you do get funding, the banker's going to want to know it. And if you ever sell your business, the attorney's going to want to know it. So there you go. How's that?
That's good, good
Pass it on.
segue.
All right,
Perfect.
good day.
Thank you, Greg.
Thank you.
Thank you.
Thank you. This is, and again,